This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed, we are across Bloomberg platforms. It is Tuesday, August 18th, 2026. August, like flying by.
One day at a time.
One day at a time. Every day feels like several days. Joe Doe, of course, the amazing Joe Doe with us. He is Bloomberg News senior economic statecraft reporter, covering a lot of stuff that just intersects in our current world. We're going to talk about some of that over the next 3 hours in total. But we're also going to get into, Joe, I think it's safe to say, what we are seeing in terms of global rates. It's a different environment. Something is going on. Some of it's war, some of it's inflation, some of it's that AI spend.
Right. I mean, as we were discussing yesterday, fundamentals have changed around why this is happening.
Exactly. So we thought it was worth getting into today. So we're going to get into that. It's kind of a 1-2 punch, if you will. That's that global bond sell-off. You've got a semiconductor sell-off. All 30 names in the stocks are lower today. Oil topping $85 a barrel, with the U.S. and Iran stuck in a deadlock over control of the Strait of Hormuz. So we're going to get to the trade in just a moment. Having said that, we are going to do a deep dive, a little bit of a roundtable on global rates. We're going to get into that. We're going to talk also about what's going on in China, because it does feel like they're going through some issues too.
Just a bit.
And you know what? In case you didn't know, U.S. and China, biggest economies in the world. What they do impacts so many others. We're going to get into that. And also, Alex Timm, co-founder and CEO of Root. It's an insurance company, auto insurance, trying to change the way things are happening. But they had tough earnings, and the stock is down a lot. So I'm curious to see what he has to say about the business. But let's get you going on this Tuesday with a check on the trade. Here is Amy Morris in for Charlie Pellet.
Thank you, Carol. A sell-off in Chipmakers sent stocks lower. We check those markets for you all day long here at Bloomberg. The S&P 500 down 0.6%. NASDAQ down 1.25%. That's about 342 points. The Dow down 0.25%. The 10-year Treasury yield at 4.7%. The 2-year yield at 4.17%. Crude oil inching higher. WTI at $85 a barrel. Brent crude topping $91 a barrel. The Philadelphia Semiconductor Index more than 5.5% lower, led by Micron, which continues to fall, now nearly 8% lower. Longer maturity bonds are at the epicenter of anxiety about pretty much everything from inflation to the debt-laden AI boom. One fear is that persistent geopolitical turmoil will make economies more prone to supply shocks and inflationary pressures. Bondholders are also worried that governments will fail to rein in spending. The 30-year Treasury yield right now is 5.28%. Walt Disney's ABC network sued the FCC for allegedly waging an illegal retaliatory campaign against the broadcaster to punish it for editorial decisions disliked by the Trump administration. ABC is seeking a court order barring the FCC from taking further action on its early license renewal applications or attempting to alter the network's exercise of its editorial discretion. Disney shares more than 1% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Businessweek Daily with Carol Masser and Joe Doe.
All right, folks, that is your setup on this Tuesday. Carol Masser, indeed, with Joe Doe, in for Tim Stenivek, who is off this week on vacation. Let's get to what is top of mind for a lot of the Bloomberg terminal readers. Sovereign borrowing rates are surging around the world, with yields on 30-year U.S. Treasuries rising to the highest since 2007. We talked about, you say 2007, you kind of perk up.
You have to perk up, right?
Yeah, you do. There are domestic factors, right, that have a role in each market around the globe, no doubt about it. The structural forces driving up yields are global in nature, though. One fear is that persistent geopolitical turmoil will make economies more prone to supply shocks and inflationary pressures. Bondholders are also worried that governments will fail to rein in spending. That is certainly a global thing, pressuring fiscal health. Meantime, changes in market structure and demographics are resulting in waning demand from once steady buyers. So there's a lot going on. Let's get to our rates Roundtable. It's a killer duo. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. He's in our Bloomberg Princeton Bureau. And then Davide Barbuscia. He is Bloomberg News Corporate Finance Reporter on set here in New York. Ira, Davide, welcome, welcome. I should point out a story, too, that has been on our minds. Came out yesterday. We're a little obsessed with it. Davide was part of it, and it was yesterday's Bloomberg reporting on how AI is driving up Treasury yields. It just touches everything. We're going to dig into that in just a moment. Ira, I want to come in, though, first with you. Your read on what's happening in the U.S. rates market, in the global rates market, and how connected they really are, or not.
Well, they're extremely connected, and I would say that one of the big reasons why we do have this rise in 30-year U.S. Treasuries is there's alternatives now for people to buy other bonds. So Japanese government bonds, when you hedge it back into certain currencies, winds up yielding more than U.S. Treasuries. So now there's the Treasury yields have to compete with yields from other countries. So that creates this very high correlation between a lot of the developed market government bonds. And a lot of the things that you just said, Carol, things like fiscal issues, not only here, but abroad as well, right, in Japan, Germany, the UK in particular now, right, you wind up having the situation where people are worried about the long-term health of these developed bond markets, and that's all feeding in to this frenzy of I'm not going to say it's long and selling, because I have yet to meet anyone and talk to anyone who's actually selling, but they're not necessarily buying, which means that the governments who are selling just have to attract people by issuing at higher yields.
Davide, let's bring you in here. Do you want to build on that?
Yeah, because interestingly, competition is coming also from the corporate side now. That's what's happening with the AI sort of financing wave, right? So we're seeing like a lot of corporates issuing tons of debt on the long end of the curve. So essentially long-term maturities, which is providing competition to the long end of the treasury curve. Essentially, portfolio managers have more to choose from, and that leads to sometimes selling treasuries to buy corporates.
What's the comp in corporate bonds that we've seen like this? Is there a comp?
I think it is unprecedented, quite frankly. We are seeing record levels in terms of issuance. We are at 1.5 trillion only in the investment grade market so far. And that's already 30% more than last year. There's wide expectations of
30% more than last year. Yeah. Go ahead.
No, there's wide expectation of essentially record issuance levels this year, more than even in 2020 when rates were very low. So yes, it's unprecedented.
I don't know, Ira. So all right, if they're not selling but they're not buying, that's still a problem.
Yeah, it is, and I just want to go back to say that that in terms of the long investment grade corporate bonds, which are competing, and certainly the AI issuance and other long bond issuance is certainly competing at some level, and there are people who want to hedge their interest rate risk, so that is people selling long ultra bond futures or shorting treasuries against it as well. We have seen though this type of issuance as terms of percentage of the market before. If you go back to the telecom boom in the late 90s, early 2000s, you saw a lot of long-term corporate bonds. But I was a corporate bond strategist, several decades ago now. I hate to say, but we've
all been doing this a long time, Ira. We get you. We get you.
Yeah. So when you have a lot of issuance, and particularly when it changes quickly, right? So in terms of people selling a lot of 5 and 10-year debt, and then suddenly they decide to go out the curve because they either have a funding need to go out that far, or they don't want to have a maturity wall in a couple of years. That can change the tone certainly. But when it comes to treasuries, it's not only AI, right? We have to make sure that we understand that there's a multitude of factors that are driving this that all happen to be coming together at the same time, including things like Kevin Warsh, not necessarily having the confidence of the market. So that has to increase risk premium. And you've seen that throughout most of the Treasury curve, in particular the 10 and 30-year part of the curve, where you've seen those yields rise just on the back of people not knowing if the Fed's going to be able to control the economy the way it used to.
Ira, what do you blame the most? Is it Mr. Warsh? Is it the AI issuance? Is it what do you blame the most here?
There is no most. Okay. So it's a little bit of everything. And here's the thing, like AI, the AI story wouldn't matter if you didn't have these other things going on, right? People would just be like, okay, it'd be worth 10 or 12 basis points, right? It would be like a blip and a couple of days of reasonably sized moves. But the fact that you have now, fears of the fiscal situation in the UK, you have fears about, the BOJ raising rates even further and seeing their yields above 4% for the first time in decades as well, right? All of those things are feeding onto this, and then you add on to that the AI supply story, and it just makes it much worse.
Hey guys, I want to bring into the conversation. Ed Yardeni and his team put out a research note. Of course, he coined the term bond vigilantes, and so we listened to what Mr. Yardeni has to say. In the note, it said, "We aren't pushing the panic button. However, we are closely monitoring whether the bond vigilantes might do so. We are sticking with our view that the U.S. bond yield should continue to trade in a normal range of 4 to 5% without causing any adverse consequences for the economy and corporate earnings. Nevertheless, now that the yield is approaching the top of this range, we are monitoring the activities of the bond vigilantes more closely." We've been here, I feel like, Davide, before. We've talked about the bond vigilantes. We all get crazy, and then we settle down. Is this just a case of watching, or are there signs that there is a problem and world get ready for higher interest rate costs across the board?
Well, I mean, like the push higher in risk premiums is across the board. So in that sense, we're seeing bond vigilantes also in the corporate bond market, where essentially investors are asking for higher spreads and higher returns on the on corporate bonds. We're seeing investment grade bonds basically trading at junk level yields. So yeah, the push higher is across the board.
That's a sign,
yeah.
Right?
Well, it's a sign of investors demanding more because they expect so much supply, essentially, right?
Yeah.
I just can't help but turn back to the backdrop of the Fed. And, Ira, you mentioned just kind of the confidence of the market in the new Fed chair. Could you unpack that a little bit? Because, I think a few of us have lived through a different Fed chair changes. Why would this one be any different than the others?
Well, I think because the change in communication wasn't incremental at all, right? It wasn't just a little bit of a slowdown. We're going to reduce the amount of forward guidance we give, and we're not going to, we're going to give just a little bit less information in the statement. Look, the Fed's post-meeting statement went from about 400 words to 100 words in one meeting. And
but were they good words? 100 good words?
No, they didn't say. It doesn't say anything now, right? It has no forward guidance. It has no reason of expectation. And here's the thing: like Kevin Warsh, I think so far has kind of misread what the market wants and needs. And yes, he has the communications task force. I put out a big deep dive report on that yesterday, where we're looking at all of the task forces. And the big one is communications, because so far Kevin Warsh hasn't given the market any indication of what's coming next or what will come next given any given economic outcome. So unless you do one of those two things, right, either give forward guidance or say, okay, here's the 5 things that might happen and we'll do this, that, or the other thing depending on which outcome occurs. Right. He has to do one of those two things, and he hasn't. So the market's confused, and we price in higher risk premium, like the other guest mentioned.
Okay, so a lot of uncertainty about certainly the Fed chair. We need a little bit more specificity. One thing we know real quickly, 20 seconds, Davide, we're going to get more credit or bond issuance from all these hyperscalers and so on and so forth. It's going to keep coming.
I mean, it's relentless, yes. And we're looking like, $2 trillion over the next couple of years in terms of estimates. So, yes, just in the investment grade market. So it's a lot to come, yeah.
All right, good stuff. Guys, thank you so much. This is what we were hoping to do. Davide Barbuscia, he is Bloomberg News corporate finance reporter. And, of course, Ira Jersey, Bloomberg Intelligence chief U.S. interest rate strategist, joining us. All right, let's see. This is something that is a key market story today, something we're talking about. Let's see if that too is impacting how Marta Norton thinks about today's trade and just macro overall. She is chief investment strategist at the second largest retirement plan provider in the United States. Empower has $2.1 trillion in assets under administration, thanks to more than 94,000 retirement plans under administration, including us, right? Aren't we Empower? I've got to remember.
That's right, yeah.
She joins us from the Bloomberg News Chicago Bureau. Hey, Marta, good to have you back with us. Lots to talk about. We were just talking about the global rate environment. Just start there. How much of that, I'm just curious, you see a lot across your platform. Is there an impact to what's going on in the global yield environment in terms of where investors want to allocate some of their retirement assets?
Well, I think there's a certain skittishness from retirement savers around the bond market. I think it relates more than just to this environment. I think we can look back at 2022 and the failures that we saw from the bond market from a capital preservation standpoint. And then, of course, as you have these lingering inflationary concerns, it makes people wonder whether fixed income can play the same role that it historically has. And I guess what I would argue on that front is that, certainly inflation is not a great talking point for fixed income, and certainly the supply-demand dynamics that we're talking about is difficult as well. But if we were to get to a true growth scare, I think there's still value to that slug of your portfolio. So I think it's a little bit reactionary to toss that entire portion of a portfolio out the window.
Marta, when's the last time you've had an intense discussion of fixed income with clients like maybe you're going through right now?
I mean, it has been an ongoing concern. I think a lot of clients were pretty enthused about alternative asset classes, gold, for example, Bitcoin, for example, thinking about the hedging capabilities of those asset classes vis-a-vis what they're getting out of fixed income. So I think we want to understand how the fundamental dynamics are changing for fixed income, but we also want to understand maybe the weaknesses of some of those other asset classes as well. It's just a series of trade-offs, right, as we put together the capital preservation portion of our portfolios.
What do investors ask you more about? Is it the AI trade? Is it SpaceX versus the fixed income side?
Yeah, it's pick a worry at the moment, right? I mean, what I find so interesting about the current climate, we talk so much about kind of this speculative fervor that has taken over markets, particularly as it relates to the AI trade. And there are certainly signs of that when we think about leveraged ETFs, when we think about what's happened in emerging markets in Korea, Taiwan, and those types of markets as well. But when I speak with clients, what I find so interesting is there is so much hesitancy around AI. And I think that's broader than just market concern. I think that relates to, I guess, the marketing messages that we've heard out of AI CEOs and all the transformation from a job perspective, from kind of, is the data center in your backyard or not? There are so many concerns around this particular topic.
And Marta, I mean, you write in your note about the equity positioning within and outside of AI. So is that one of the things that you're getting at with the clients that maybe are a bit more worried or skeptical of AI?
Yeah, I think it's a really important point for folks to have when they think about AI and they think about their equity portfolio, particularly their U.S. portfolio, which is the preponderance of their equity exposure, and just understanding that your AI factor is not entirely contained within the IT segment or sector within your portfolio. It's also in small caps. It's also in industrials. It's kind of sprinkled throughout the U.S. market. So one of the things I talk about is being really thoughtful about diversification, and I think it can make some sense to look at some areas that are not quite as dependent or part of the AI supply chain. And that's one of the reasons that I think healthcare, for example, has some appeal in this particular environment.
What's most important in your mind when we look at macro? We've got war, we've got Fed, we've got AI, we've got these rise in global bond yields. What really matters in your view right now when it comes, especially for those who are thinking about their retirement savings?
Yeah, I mean, I think all roads lead back to AI in this environment. I'm very concerned about the yield curve as well. I mean, we are in an environment where the yield curve just seems to have reset higher, not on the back of break-evens, but on the back of real yields. And that's something that we have to consider. But when you think about what the engine of growth is and what has been the driving force of the equity market and what it appears to be the driving force of the economy, it really is AI. And so managing that well, anticipating it, not overreacting on an emotional standpoint, I think that's really critical for investors today.
Not always easy to take emotions out of investing, though, right? Easy for us because we've got to kind of be hands-off here.
Very hands-off, but wow.
Yeah.
Difficult in that chair.
Yeah, right? Exactly. Marta, this was great. Thank you so much. Marta Norton, she's Chief Investment Strategist at Empire. She mentioned engines of growth. Speaking of that, China's slowdown deepening with momentum collapsing beyond technology, the all-important technology sector. We've got a great guest on that. We've got the COO and Managing Director for China Beige book, Shehzad Qazi, is going to join us next.
It's 2:21 on Wall Street. I'm Amy Morris. Anthropic's revolving credit facility is set to rise above its roughly $10 billion target as it gets ready for a highly anticipated IPO. Sources tell Bloomberg those talks are ongoing. A $10 billion plus revolving credit line would be a substantial increase over a $2.5 billion five-year facility Anthropic secured last year. A slump in Chipmakers sent stocks lower, with the market also falling on anxiety about inflation and rising government debt. We check markets for you all day long. Here at Bloomberg, the S&P 500 down 0.5%, NASDAQ down 1.2%, the Dow is down 0.1%. The 10-year Treasury yield at 4.7% and the 2-year yield at 4.16%. Crude oil off session highs now. WTI now less than $85 a barrel. Brent crude just shy of $91 a barrel. The Philadelphia Semiconductor Index more than 5.5% lower, led by Micron, which is nearly 8% lower. Goldman Sachs will pay as much as $410 million to buy LCN Capital Partners, a commercial real estate investor. The deal targets a booming corner of the real estate market that's attracted asset managers looking for a synthesis of real estate and corporate credit. The acquisition will allow Goldman to offer leases to its corporate clients and sell the investment to its broader distribution channel and base of high net worth investors. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. We go back to, where do we go? We go back to Bloomberg Businessweek Daily with Carol Masser and Joe.
I feel you, Amy Morris. I don't know what day it is.
It's only Tuesday.
But it feels like September. Or October. I don't know. Amy Morris, you rock. You always are on it, though. Thank you so much. We'll come back to Amy a little bit later on. We're going to talk a little bit about China. There's stuff going on.
Let's do it.
Let's
we
do
have a very highly anticipated summit between Chinese President Xi Jinping and U.S. President Donald Trump. There's many people who have been watching this, many more people who have not, and that's why we're bringing in Shehzad Qazi to discuss it. He's the COO and Managing Director of the China Beige Book International. He's based here in New York. He joins us in the studio. Shehzad, thanks for joining us.
Thank you. Good to see you.
Great to see you.
I would like to start at the summit. You had, in a recent note, some very detailed back and forth, the pluses and minuses and what may actually not get taken care of in September. Could we start there for investors who may be thinking too much of this meeting?
And this is the summit between President Xi and President Trump, correct?
That's right.
That's right. I mean, I think, once again, expectations should be very, very low for what's about to happen. I think we're going to get a day-long summit, it looks like, at most, this time around. And both sides are trying to talk about deliverables. The Chinese side wants this to be super scripted and are very frustrated. The U.S. side doesn't understand why the Chinese side is so frustrated. But at the same time, they both agree there's not going to get a whole lot done at this meeting. The big deliverable that might come out of it are details and some finalization of what that so-called Board of Trade needs to look like. Don't expect much beyond that.
What do you mean? What is the Board of Trade? Walk us through that.
So the U.S. Trade Representative famously says, I am the Board of Trade. And what that means is that Ambassador Greer has agreed with his counterparts that we're going to pick about roughly $30 billion worth of things that we are happy to import from you, we consider to be non-strategic. You'll do the same, and we're going to manage trade between us. So unlike what we've thought of trade deals as saying, look, we're going to open up free flow of trade, this is more about actually saying we're going to decide what's truly free, and the rest of the stuff we're going to slap on tariffs.
Is that a good thing?
It's driven by a national security imperative. Okay. From that standpoint.
From both sides.
From both sides, certainly from our side, and I think the Chinese side will determine what their national security priorities are. So there are positives to it. I don't know how much it'll do in the long run, though, to take care of things like supply chain dependency on China and so forth, because it doesn't address the other critical issues like transshipment, which is a big one staring us.
Can you clarify how much we still rely on China in terms of supply chains, global supply chains?
Immense amount, right? There really isn't anything in our homes, in our industrial centers, in our data centers, really even factories that is not coming, our hospitals is not coming by and large from China. What they did with rare earth metals really scared us because I think it created this other discussion. Said, think about what if they did that with pharmaceuticals and surgical supplies and medical goods. Forget about everything else. Yeah, so a ton.
And Shehzad, I mean, that's why we're kind of here right now, right? We have the export controls that China puts in place on critical minerals and permanent magnets. The United States says we're going to do the same thing on chip technology. And ultimately, the two sides who are, heavy hitters in the world economy say, okay, we got to reach some sort of truce here to calm markets down globally and also to calm this diplomatic relationship down.
Yeah, and I think one idea was, really the predominant idea was that if the two leaders keep meeting each other, then the truce continues. Now everybody realizes the truce is because we need the truce because we don't have the rare earths and the magnets. We're wholly dependent on China.
We don't have a choice.
We don't have a choice. And the Chinese want the truce because that's the best way to keep kicking this thing down the road, to push off tariffs for as long as possible, run out the clock on Trump, and then you deal with whoever the next president is.
How's China feeling about the United States? And I bring that up because Chinese Foreign Minister Wang Yi will visit South Korea for 2 days from Wednesday to talk about North Korean bilateral and global issues with South Korean Foreign Minister Cho Hyun. And this is coming after President Trump ordered the Pentagon to reduce joint exercises with South Korea, citing their cost and his relationship with the North Korean leader. And there was also some connection with Iran and supporting in the denuclearization. What's your political read on that?
So I don't necessarily align myself with the idea that wherever the U.S. tries to withdraw from a geography or something, China will try to step in necessarily. But at the same time, China is always... Will it at least embolden them? I think it can certainly embolden them, even if they don't want to take action immediately. Certainly, they may feel like they could, and potentially the probability of success goes up, if you will. So they're doing all of this. I think on the other hand, vis-a-vis even the United States, though, on the other hand, even when they're showing up here, they are taking an aggressive tack. They're saying, look, we're watching what's happening in Congress. We're watching that, you guys are now blaming us for an election interference, and we don't like this. Don't try to threaten the truce. So apparently the tough talk is happening behind the scenes.
I think oftentimes all of us kind of look at this from the perspective of the U.S. and what's the U.S. have in it. But maybe we could bring you in to look from the vantage point of China right now, right? There are economic pressures internally. How do those play in this broader discussion?
Yeah, I mean, in some ways, this really is, I think she's, the genius move, if I can call it that. The economy internally is pretty weak. Not only is the consumption side weak, the household side weak, and not only are they completely sort of failing to embark upon this economic transition that they've been talking about for, decade and a half, really, certainly at least the last 5-6 years in earnest. They are failing on all those accounts, yet they are able to, because the export machinery is running, they're able to, show up at the table and deal with the U.S. not just as competitors and equals, but ones that oftentimes look like they have the cards rather than us.
Does it ever matter? Because we always talk about Chinese deep pockets, right? And the government's always there to either boost up a company or boost up a sector. Those pockets are still pretty deep, right?
The pockets are still pretty deep, and whereas their traditional way of doing stimulus isn't working, we have to remember they haven't really attempted household style side stimulus at all. So that's a whole other playbook that they could resort to.
Will they?
They just don't ideologically like to do that.
No,
it is ironic. It's a communist party, and they don't like to do welfare. But they could if they wanted to. Push come to shove.
I mean, all of this comes down to job. That's the power that the Politburo, that the Communist Party has within China. Of course. I mean, the growing middle class since Deng Xiaoping, just speaks volumes to that. But as you embark on this AI transition, what does that do to what is still a very deeply industrial-based jobs economy?
Yeah, I think that is a big challenge for them. They do not have an answer for this as yet. They're already staring at, obviously, a very large youth unemployment problem. These young people will eventually become older, so you have to do something about them, plus the new entrants. The Communist Party certainly has a big challenge ahead of itself on that.
Yeah, where are they in this transformation? We talk about whether it's EVs or, pick even AI, how advanced they are certainly when it comes to robotics and so on and so forth. So it sounds like they're so advanced and that we should be worried. Yeah. But is that true?
They are advanced, and we have to remember that we're talking about...
And a risk to the U.S. in terms of high tech and so on.
Well, certainly. I mean, we can compete with them at this point when it comes to things like robotics, right? There's no factory in America that could just say, oh, yeah, we're competing with the Chinese when it comes to automation and robotics and such. And we have to remember, we're talking about AI-related job losses a lot in this country now. That transition to automation, especially in the manufacturing side, has been happening for a long time in China. So they sort of know how to deal with it by now a little bit also compared to maybe other economies. But they are certainly very far ahead.
It's incredible.
So what should investors be thinking about? You know, we've been talking about China forever, and for such a long time. I know when I started my career like decades ago, you know, it was all about having access to the Chinese market. That's what was important to every global multinational company. We think differently post-COVID, post what have you. And so I do wonder how investors have to think about China's relationship with the world. We know China is friends with Iran, with Russia. You know, we talk about this other kind of axis of power, North Korea. What is their role?
I think their role from an economic standpoint is that you have to look at what China is becoming as a state, which is that they want to be this a high-tech superpower. They want to be this industrial giant. They say we'll make the cheap goods and we'll make the advanced, sophisticated goods. And the Chinese commodity story is incredibly interesting still. I mean, what's happening with oil, but even what's happening in other places. Steel demand is down, yet China's buying up all the iron ore it can, right? So those relationships have broken down. They're not what they used to be. And so there are some interesting things happening inside the economy. And the traditional model of thinking about China just doesn't apply anymore. You really do have to kind of watch it at a granular level.
Yeah, you know, the trade hawks still are stuck on overcapacity and subsidies, right? And we even saw Peter Navarro put out a report that's made the rounds in the past week. I mean, what do you make of all of that still hanging?
You know, my message to my friends in DC has always been that you can talk about Chinese overcapacity all day long. It's not going to make an inch of a difference unless you can compel American companies to rethink their supply chain strategy in a very, very holistic and broad way.
As long as though the government, now here's the funny part, right? Because you have the U.S. government getting involved in our companies now. So I do wonder, you know, kind of how ironic that this is. But as long as we know the Chinese government can actively and aggressively get involved, is it not ever going to be a market that investors, global investors, really want to embrace?
Well, if you're aligning yourself with companies that are in the state's favor, sectors that the state is favoring, then there's a pretty good chance that you could get in there and you can make money, especially with this, the plethora of companies that are IPOing out of Hong Kong now,
right.
So, including Shanghai, of course, as well. So you've got that. But yes, you have to be very, very careful because, you know, look at what happened to Baba and so forth. The state decides the winners and losers at the end of the day.
Just a real quick one here. What is the one thing through the end of the year that you think investors should be paying most attention to with China?
Right now, I would say figure out what could break this truce maybe past November.
Okay. That's a big one to keep on our radar. Always important to China. And we were remarking, it's been a while since we've talked to you, and how the news flow, and certainly out of the White House, has had us so focused on the Middle East as of late, but you can never, ever forget what's going on in China. Shehzad, thank you so much. Let's make it sooner. Shehzad Qazi, he's Chief Operating Officer and Managing Director for China Beige Book International, joining us right here in studio. Quick check on the trade, folks. It's kind of an interesting day, and you are mostly seeing the selling on the tech side of things. That NASDAQ 100, it is down almost 500 points, a decline of 1.6%. Bring up something like the stocks, and you're seeing most of those names lower. I think all 30 we've seen lower. Now about 28 of them are down on the trade. The index, a decline of 5.6%. When we come back, a company looking to upend the auto insurance market and more. The co-founder and CEO of Root, Alex Timm, joins Joe and me. This is Bloomberg Businessweek Daily.
$240 on Wall Street. I'm Amy Morris. Meta Platforms now facing a jury trial in federal court over claims that it deliberately designed Facebook and Instagram to encourage compulsive use among young users. The trial carries enormous risk for Meta, with potential penalties of as much as $1.4 trillion, and could have a material impact on the company's business and how its platforms fundamentally operate. Meta shares now nearly 4% lower. A chip rout is pulling stocks lower. We check markets for you all day long here at Bloomberg. The S&P 500 down 0.5%, NASDAQ down 1.2%, the Dow down 0.1%. The 10-year Treasury yield at 4.7%, the 2-year yield at 4.17%. Crude oil off session highs, WTI less than $85 a barrel, Brent crude right at $91 a barrel. The Philadelphia Semiconductor Index nearly 5.5% lower, led by Micron. That's down about 7.5%. New residential construction in the U.S. fell in July as single-family starts slid to the lowest pace since 2022. Housing starts decreased 12.4% last month to an annualized rate of 1.24 million. That's below all estimates. The slide in starts points to a housing market that's struggling to gain momentum. Pending sales of previously owned homes dropped in July to the weakest since the start of the year. An index of contract signings decreased 2.3% to 71.2. That is the lowest since January and matches the second worst reading in data back to 2001. Mortgage rates, which have climbed higher since the start of the Iran war, and elevated home prices still weighing on demand. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Businessweek Daily with Carol Masser and Joe Doe.
All right, good stuff. Amy Morris, thank you so much. Well, shares of Root, it's a small cap P&C insurance company. It did sell off following earnings earlier this month. Stock down about 16% on August 6th. That was as the company reported earnings per share above estimates and sales below estimates. Stock, by the way, down 28% year to date. About 19% of the float is short. We wanted to get an update on the business, and joining us to do just that is the co-founder and CEO of Root. He is Alex Timm, and he joins us from Columbus, Ohio. Alex, it is good to have you here. I do want to talk about the business. Your share price, though, pretty negative and getting beat up by investors. What are you hearing from your investor base about what they want you to be doing or what they want to know about some of your financials and your metrics?
I mean, listen, we had a great quarter, and we've had a great first 6 months of this year. We delivered a return on equity over 30% when you annualize it. You look at that relative to our peers, and that's almost unheard of. And there were certainly some competitive pressures in the quarter, in the first couple of quarters of this year in terms of growth. But when we think long term, we're still in 37 states where we have our applications live in 11 states, so we're going to be scaling nationally. Our partnerships platform is growing really nicely, as well as our embedded insurance platform. And so we're continuing to grow long term. We think there in this environment in certain quarters, we don't chase growth. We're disciplined, and so you won't see us push after growth when the competitive environment gets really hot. And we think that that's really good, actually, for long-term shareholders. And so we're sticking to our discipline. And sometimes it's tougher than others, but we think over the long term, that's how we build a great company.
Obviously, insuring autonomous vehicles. I'm wondering a little bit more about that transition. So obviously, everybody knows getting insurance for their automobiles, but what do you do when you go from human to autonomous? How does that actually work?
Yeah, so that's a great question. First, the reason we founded the company was to understand risk. We believed that, and I think we've been shown now, that the nature of risk, the nature of predictive science is totally going to change in auto insurance. So you think about what auto insurance companies do, right, is we ingest a whole bunch of data, and then we try to predict who's going to get into an accident. And the amazing thing is, if you look over the last 10 years, the data that we can use and the data science we can apply to that problem has dramatically changed, whether that's mobile telematics or whether that's connected vehicle data. And it's continuing to change with autonomous vehicles. So for us, what we're doing is we're actually, it's very core to our embedded strategy, where we're working with OEMs to understand the data coming off of these vehicles so that we can understand what does that mean for risk. Right? Not all this technology is created equally. Using the technology in different times. If you're in autonomous mode and you're going down the highway, that's quite different than if you're in autonomous mode and you're going through downtown. So you've got to actually really understand how do all of these things impact the risk, the underlying risk of what's occurring in the world. And to do that, you have to be the first to get the data. So we're studying that data. It's still, the vast majority of miles are still human driven. So it's not been a huge macro shift that we've seen yet. But as we're studying that data, we're starting to understand exactly what does that mean for risk. These cars still crash. And so they still need insurance. It's just, when and how do they crash?
What does the early, though, look and analysis that you guys are doing on the data from autonomous vehicles. And even, I mean, you think about the cars today, man, I turn on some different things. I can take my hands off the wheel, drives really well. And if I get distracted, it stops if the car stops in front of me. So I am curious, you've got to have some early analysis on this data, and maybe it's semi-autonomous and autonomous completely. What are you seeing? Are they less likely to get into a crash or an accident?
Absolutely. So fully autonomous vehicles are certainly less likely to get into an accident. The semi-autonomous is tricky because people do take their hands off the wheels, and now there's more distractions in cars than ever before. You can even watch a movie in the car in the center console. And so that's tricky because what you see is, although in autonomous mode, oftentimes frequency is less, so these vehicles aren't crashing as much, severity can actually be much higher because sometimes these vehicles won't even see the hazard coming. And so you've got to be really careful with this because it really depends on how it's being used. It's not just if it's being used, it's really where in the situation and under the situation in which it's being used, and then making sure that people know for the vast majority of this technology, you really need to be ready to put your hands back on the wheel because it does fail. It's not fully autonomous yet. So, when we look at the industry overall, although frequency is down, we're actually seeing severity up significantly. And so it's still the auto insurance industry is actually still growing despite this technology.
Alex, I wonder, though, you talk behaviors versus demographics. What does that really mean? Like, I remember the first time I got insurance as a 16-year-old. How is it different than, more than 20 years ago?
I mean, yes, so much has changed. Basically, everything has fundamentally changed about insurance over the last 20 years. When we talk about moving from demographics to behaviors, before when you were a 16-year-old male, we all just assumed you're a terrible driver. It turns out when we actually look at 16-year-old males, some of them, are very risky drivers and dangerous drivers, and they need to be priced appropriately. But others actually have really good responsible behaviors and deserve huge discounts, like 80% discounts. And by moving away from demographics and more to behavioral data, we're able to more accurately price risk. And that's also really good for the customer because the other thing it allows us to do is actually put those behavioral data feedback back into the driver's hands and the customer's hands. So, you couldn't change the fact you were a 16-year-old male. You can change the fact that, maybe you were driving recklessly. And so we're also giving people more financial control by moving to more behavioral data. It's just a fairer system fundamentally.
Hey, listen, just got about a minute left here, Alex. Industry overall, insurance industry, position of strong profitability. Major players are all looking to grow their market share. Has route seen price and advertising competition pick up? And I am curious where you see the biggest opportunity, ideally, to gain share. And forgive me, just about 40 seconds here.
Absolutely. We definitely have seen competition pick up. You're seeing cost per click go up, almost 100% year over year, and you're seeing shopping down. So you're seeing just this huge amount of competition in the space. For us, where we see really attractive growth is in our embedded platform selling insurance directly with vehicles, as well as our independent agency platform, where we're still in fewer than 20% of agents nationwide. And then national expansion, we're in about 80% of the population today, and we're going to take that to 100%. So we've got some good sort of secular growth drivers in the business.
We'll stay in touch. Let us know how things are going. Joining us right now here on Bloomberg has been Alex Timm. He's co-founder and CEO of Root. Hey, when we come back, Joe and I taking a check on the trading day and also some stocks on the move. Stick around. You're listening and watching Bloomberg Businessweek Daily, and this is Bloomberg.
This is Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody. We're heading into the 3 p.m. hour on Wall Street, almost there. Right now, we've got a market, Joe. Carol Massar along with Joe Doe. Joe is in, of course, for Tim Stenovec this week. We've got a market that definitely feels like risk off, especially when it comes to some of those big tech names, in particular semis. But you're looking at a NASDAQ 100 down 509 points, down 1.7% here. So off its worst levels of the session, but definitely a different tone. Yesterday was kind of meh on the equity side. I think people keep looking at the rates market.
Yeah, it feels like everything builds day by day.
It does feel like that, right?
Yesterday, maybe a little less worry. Now today, kind of catching up to folks.
Right, because it's, continuing in something. All right, so we're going to talk about that. I'm Carol Master along with Joe Doe. Let's get, though, to some specific stocks on the move. We do have some big winners and losers. Here to do that is Bloomberg TV Markets correspondent Nora Melinda. She's here in studio. Good to have you here. Interesting day. A lot of selling, it feels like, on the tech side of things. Let's start with Klarna, though. You're watching that one.
A real laggard. The stock is down about 22%, earlier down as much as 23%, heading for its worst day since February. Now, this comes after the company cut its revenue outlook, and essentially it's citing some of those currency exchange pressures, but also they talked about weaker consumer spending in Germany, so that really weighing on some of the results and clearly how investors are really digesting this performance. And the company hasn't been doing very well this year. The stock is down 47% so far for 2026, so tough day for investors of Klarna.
Is Germany really important to them? Forgive me for not.
I mean, I was thinking the same thing. I guess it must be enough to actually rock the boat, clearly.
Yeah, exactly. Yeah, I'm looking for revenue breakdown, so we'll dig a little bit deeper into that. Stock's down almost 50%, right, year to date. So interesting.
But then also, I want to call out the fact that the CFO is also anticipated to step down. So, of course, when you see also some of those management shakeups, that is also going to rock a stock a bit.
Yeah. Sorry, I'm just looking through the numbers. This is when I go through a deep dive. And right. Like, you're going to lose me. You're going to lose me.
Stay with us, Carol.
Yeah, the outlook, though. Yeah. All right. Lots of questions there. Let's go on over to, I love Home Depot.
Do you now?
I'm just going to put it out there. It's fun to kind of go up and down the aisles. I'm just going to put it out.
You know what's so funny to me is, Home Depot is actually geared toward contractors, and Lowe's is geared toward the DIY consumers like you and me.
That's right.
But I find myself in Home Depot. I don't know what that says about the two of us.
When we first bought our house a bunch of years ago, man, we were in and out of Home Depot, and I just loved it, like walking down. I'm like, I want to buy some lumber. Let's do it.
I always lose cell phone service in the back. That's when you know you're a little bit too deep into the store.
All right.
But we do see shares rather, of Home Depot higher by about 0.1%. Performance isn't too interesting in terms of the stock move, but we did see the company beating expectations. This, of course, even as we still deal with this challenging housing market where you see the 30-year fix sitting at 6.7%, still at a high if you compare it against a year ago. So you're seeing some of those contractors coming out, but what the focus really is on some of those smaller ticket purchases. Think plants, paint, tools, not the big home kitchen renovations that what we want to really see happening when we see things turning around.
And then there's always like, well, if I need some like cleaning supplies or like, it's just everything there.
Talking to our eco team this week, it's just the relentless rise of the U.S. consumer.
Yeah.
Like, it just... Yeah. Every time you're like, things feel off here, but no, they're still there. They're still showing up. They're buying.
They say never bet against the U.S. consumer. I mean, it's interesting, especially as we still, to your point, we still remain in this challenged job market, and you think about the economics more broadly, but you still see some pockets, at least what I'm hearing from analysts as it relates to Home Depot, they're still being selective, though. So we're not seeing a full recovery, but you're certainly seeing them picking up things here and there, and apparently it's some of those smaller ticket
projects. That's what I tell my husband when I'm out
projects.
shopping. I'm doing my job for the economy, honey. Hey, our Sebastian Escobar says, I bought a 0.21 cent nut the other day. That's what's great about Home Depot. You can get one screw if you want it. I feel you. And Amy Morris also chiming in saying, I kind of, I love the new house smell that's in there. It's like a new car smell kind
I'll
of thing.
have to check that one out now.
All right, we're going down a funny road here. HD, of course, is the ticker on that one. What do you want to wrap up?
Have you guys used Duolingo?
Por supuesto.
Oh, look at you go.
Yeah.
Now I need to go translate that on Google Translate.
Of course.
Or maybe Duolingo and do some more research.
That brings us to Duolingo.
Yes, ticker DUOL. The stock is up, actually having its best day in exactly a year. This comes after D.A. Davidson upgraded the stock to buy. They're essentially saying that the company is getting close to a turning point, and that marketing and money-making strategy is actually better than investors are realizing. So they say that the company has plenty of room to continue growing. The stock has been pretty pressured, though, this year. If you take a look at shares year to date, they're down about 19%. So I can imagine that this is some pretty welcome news for some investors of Duolingo that D.A. Davidson potentially sees some upside.
Yeah, Tim Stenevec loves this one. He's actually talked to, I think, the CFO and also the CEO and has been tracking. But you're right, it's down almost about 19%. 21% of the float is short. So there's a negative sentiment there. Good stuff. Muy bien. Do you speak another language?
I took 4 years of Mandarin Chinese.
Wow. Oh,
that's
Forgotten
impressive.
most
that's
of it,
great.
though.
I took
Really?
Latin. I did Latin. I thought maybe pre-med, I thought that it would help me with it didn't really work out that well. But 10 years of Latin, a dead language.
Yeah. No, but it's great in like understanding the roots of words.
This is true. Those romantic
stuff.
languages.
Helped on SATs.
No Chinese.
Yes,
no
that part.
Chinese from you.
Ni hao ma. The easy stuff.
Well done.
I like
Jojo.
that. I like that.
All right, Nora, good stuff. Thank you. Check out our Stock Movers podcast. 5-minute episodes, big winners and losers in the stock market. You can find it on Apple, Spotify, or anywhere you get your podcast. Joe and I continuing on Bloomberg Businessweek Daily. The close coming your way on television.